Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with, quite frankly, a growing fan favorite, Mr. Dan Bird, and our talk about the stock market. How you doing, buddy?
Good morning. Very well. Did you have a nice Thanksgiving?
I did. I got to spend some time with my daughter, have some good food, see some family. Olivia got to see some college friends. It was an amazing time. I did miss my conversations with you, and the audience was like, "Are we going to still get Dan?" I'm like, "I'm on vacation. Sorry, not going to have Dan, but we'll bring
How
on Dan
dare
next
you?
week." How
How
dare
dare
you
you?
have a vacation? So let's
Well,
talk about.
the market's still there. So
Yeah. Oh no, it's still there. So I still look at the market. I still do what I do, but we did not do any interviews. It kind of still feels like the same story. The market doesn't believe the Fed, if I were to summarize it.
it's a different story now.
Oh, it is a different story. Okay, all
Yeah,
right. What do we got?
we'll talk about that. Well, we'll talk about it when I show the charts and what happened last week. But yeah, it was an interesting week last week. We the Fed spoke. He didn't really say anything different.
No, that was Wednesday. Yeah, Jerome Powell did not say anything different. It was we're going higher, we're going slower, going to be there longer. But all the
Yeah,
market heard.
actually, let me share my screen because I
Yeah,
actually talk about this in my newsletter.
you did. I saw it. So go ahead.
I'll put my newsletter up.
Mhm.
Let's see here. Right, here we go. This is actually going to lead into some of the things I want to talk about today anyway. But here, I thought this was pretty interesting. This is from another newsletter that I get. And they put in what Powell said in November. There is significant uncertainty around the end point of rate hikes, indicated by stating we have some ways to go. If we over tighten, we can support economic activity. That was November.
Mhm.
1 month later, the time for moderating hike pace may come as soon as December. I don't want to over tighten.
Mm-hmm.
All right. So he basically was saying the same thing, but he said it a little differently.
Yeah, what I would summarize November is almost like we're going to over tighten, and I know how to fix that. And now
Yeah.
he's saying, "Ooh,
I'm going to
I
fix
don't.
that.
Yeah, I don't want to do that." Yeah.
Right. So the market took that as dovish.
Mm-hmm.
I'll show you where we are with the market here in a second.
Yeah, yeah.
But
Let me translate what I think this means. Because I actually put this on my daily show.
yeah,
What I think happened in those two statements, and you're absolutely right, those were them, was the first statement from November, and then you add on top of that James Bullard throwing out, hey, we may have to go to 7% Fed funds rate. I don't think the I
that's
don't
not what he said. That's not what he
no,
said. But
that's what the
that,
market heard though.
that's what everybody said that he said.
Yeah, exactly. We agree on that. That's
What Bullard actually said was if you use the Taylor method and
correct. The range of
apply that calculation to it, then it indicates that 7 would be the peak, would be the highest we should go.
right.
If you apply the Taylor method, then the
Right.
peak should be 7. And everybody
All they heard
else,
was 7.
all they heard was Bullard saying we're going to 7.
Yes, exactly
That's
what I'm
not
trying to say. Agreed.
that's not what he said.
But that's what the market heard.
Right.
So what I mean by that is heading into that, because again, if you go Fed Fund 7, mortgage rates are 10%,
Yeah.
roughly speaking. And that was a big kerfuffle. And
Yeah.
then what they did last week is they took Fed Fund 7 off the table. I would argue and postulate they also took 6 off the table. So now after we get our 50 December 14th, what I would tell you is we're almost there. I see no reason to change my terminal rate call of 5. But I think what really happened last week is Fed funds of 6 and 7% next year are off the table. I think that was a big difference.
Yeah. I don't think they were ever on the table, but yeah, I mean, maybe he clarified it because the market misinterpreted what Bullard said.
Mm-hmm.
But Bullard didn't say that 6 and 7 was on the table.
There. But that's what the
So
market heard. Yeah.
yeah, that's
Okay,
what the market
cool.
heard. But yeah, so anyway, the market thought of that as dovish.
Yes.
But is it really? Is it
No,
really dovish?
it's not. In reality, it's not. It's 95% the same. It's not that dovish, in my opinion.
Mm-hmm. Yeah, nothing really changed.
Agreed.
Well, what changed was clarity, I'd say.
Yeah.
Clarity changed, but the numbers didn't change.
The numbers didn't change. We have more clarity. And again, what is clarity? We know the endpoint is near. That's what happened.
Right. So if anyone is interested in getting my newsletter, send me an email to breakpointtrading@gmail.com. And I'll add you to the list. It's free. Get it every week.
Yep. Yeah, I enjoyed it. It was a great read while I was gone. It made me feel connected. So I appreciate it.
Yeah, no problem. So let's talk about that little chart in the lower right. There's a couple of cartoons up there that I put cartoons in my newsletter every week.
Yeah, the Venmo one was awesome.
Yeah, isn't that funny?
It is hilarious. Oh my goodness.
It's interesting that I've been doing this. I've been doing the newsletter for a long time, but the cartoon part I've only really been doing this year, and I can never run out of cartoons. I can always find some new ones.
That's
so
funny.
Anyway, I was listening to CNBC, and Katie Stockton, who is a technical analyst that I really respect. I mean, she really knows what she's doing, knows what she's talking about. So she put this chart up there on the show.
Okay.
And what that basically says, and I created one similar to this, which I'll show you in a second.
Mm-hmm.
But this basically is the white one is where we are right now. This is the VIX. Mm-hmm. All right, the volatility index. When the VIX starts going up, that means the market's going down, usually.
Okay.
And when the VIX goes down to the low, like 20 or below, that means the market is going up. Mm. So below 20 is basically complacency or optimism.
Okay.
And above 30 is right here in the middle, but above 30 is usually pessimism or volatility, selling, usually selling. Okay.
Okay.
So then she put next to it what the June 2007 to October 2008 looked like. Very similar, isn't it?
Interesting. Yeah. Okay.
And then you remember what happened in 2008 with the market.
Oh, I absolutely. So let me kind of translate this as a novice and somebody who's not seen this, or at least not understood it at this level.
Yeah.
Basically, the VIX in the 08 crash was kind of low or moderate until
leading up to the crash.
Right. No, right. Leading up to. And then all of a sudden it just broke.
Right.
It much higher. Okay. I got
you. That's when Lehman collapsed and all that started happening. That's when the VIX got up here towards this level, and then Lehman collapsed, and then it just all hell broke loose.
Got it. Okay.
And her point was, this looks very similar to what it looked like back then.
Yeah, I mean, as charts go, yeah.
Mm-hmm. Right. Mm-hmm. So she's implying that we might have some kind of black swan event coming up.
Yeah, there's an event in the near future
that might push the market down again, just like it did back then. Now she's been saying 3,200 for a while. That's her target.
Yeah, and I've heard.
Maybe we could get there. So let me move forward to the next. There's Katie Stockton.
Mm-hmm. Give her full credit. Yep.
If anybody sees her on CNBC, she's worth listening to. Very straightforward, down to earth.
Yeah, I like what she has to say.
Yeah, it's basically not emotion. It's just, here's what the charts say, and this is how I interpret.
Yeah.
All right. So this is the one that I created based on what she said.
Okay.
So 2007 to 8. This is the VIX again. It's on the top. I put in the 35 level.
Okay.
So that's the most that I got to leading up to the crash.
Got it.
And where we are right now. All right, 35 level leading up to, well, we don't know if it's going to crash, but you can compare the two. They look very similar.
Yeah.
In fact, you can even look at the lime green areas, which is when the VIX starts going up, starts spiking higher. They're kind of in the same positions too.
Got it.
Right? Mm-hmm. So then let's look at pay attention to the 2007 to 8. Okay. After this point right here, there's what happened. Now, we don't know yet for where we are right now because we're right here. This is the far right-hand edge of the chart.
All right. So basically, right. And that's 90 days.
So we don't know if this is what's going to happen.
No, of course not. No,
yeah.
Of course not. Yeah.
Now let's look at the S&P during that same period. All right, same dates.
Interesting.
June of 07 to 08. It's kind of going down. 21 to 22. We actually have been going down longer this time than we were back here.
Okay.
All right, but kind of the same pattern.
Yeah.
And then in 2008, what happened after this? And remember, we're at the far right-hand edge of the chart right now.
I see it.
So in 2008, there's what happened.
Ooh. Bottom fell out.
So is that going to happen again?
Who knows?
If you'll notice, this one went right up to this trend line right here.
Yep.
And that's where it broke. And we're not quite at the trend line yet. This is the NASDAQ 100, by the way.
And these are weeklies?
This one is a daily chart.
Oh, daily. Okay. Sorry.
This is a daily chart.
All right.
All right. So this is her hypothesis. Okay. We don't know what's going to happen. Nobody knows. We don't know if it's going to look the same this time as it did this time. We don't know that yet.
Okay.
But if it were to, it would happen right when it hits this trend line. Right.
What was the percentage drop? So that's what, 1920 to 1500?
Yeah, in 2008, the percentage
20%.
drop. I can't remember what it was, but it was something like 40%, I think.
Yeah, well, I think the number is 1920-ish. Actually, no, maybe higher. 1940, the green line, the peak to all the way down to 1500.
So let's talk for a second about my hypothesis about secular bull and secular bear markets.
Oh, yes. Yep.
Because every time I see charts like this from anybody, I always relate it back to the secular markets. So here's the secular bull, secular bear. So her first chart, 2007 to 2008, was right here.
Okay.
This was in a secular bear market.
Yeah, correct.
Secular bear. When it had that big drop off right there that I just showed you.
Yep.
We are now in a secular bull market.
Okay.
So inside of secular bears, there will be rallies. There will be cyclical bulls. So there was one inside of this one. And after the 2000 crash, we went down. And then we had a really nice run for about 3 or 4 years. But we never broke above the high from the dot-com crash.
Right.
We didn't break above the high until 2013.
Got it.
So we went back down again, which is what I just showed you before, and then we started coming back up. That's a secular bear. We are now in a secular bull. Secular bears usually last about 12 years. Bulls usually last about 18 years, 18 to 20. All right, we've still got probably 8 years left in the secular bull market.
Yep.
All right, so now let's look at the cyclical bear markets. Cyclical, that means inside of the secular bulls. So the bear markets that are inside of these, there's the 1987 crash right there. That is a cyclical bear market inside of a long-term bull.
Okay.
All right. Here's the COVID crash right here. That's a cyclical bear market inside of a long-term bull.
Okay.
So these are the cyclical bear markets going back to 1957. The percentage decline, you can see here when this is actually Tom Bowley did this one. When he did it, it was June 17th. We actually went lower than his low right here. We went down to 34.91. Okay. So instead of 24.5, we went down to 27.5. But it's still within the range of all of these other cyclical bear markets.
Sure.
Cyclical. Look where they were 6 months, 1 year, and 5 years later. So 6 months later, all of them were higher. 1 year later, all of them were higher. We don't know about this one yet.
Right.
All right. And then this is one that was in Real Investment Advice, which is a newsletter that I get. And they published this without the boxes here. I'm the one that put the boxes in.
Okay.
But here's what they said. You will note that bear markets occur when the 200 weekly moving average gets broken. That's this blue line.
Okay.
So during the secular bear, it got broken. All right. Corrections generally occur over short time frames, do not break the prevailing price trend. Bear markets tend to be long-term affairs where prices grind sideways or lower over a year or more. All right, so there's the secular is the shaded areas. Secular bull is green, secular bear is red. And then the boxes are the cyclical bears inside of the secular bull.
Oh, I see.
And the cyclical bulls inside of the secular bear. Okay. And there was one little bear market back here in 1998.
Okay.
All right. So it's important to understand that. It's important to understand when anybody on CNBC or anywhere else puts charts like that up. When she was comparing the 2007 to 2008 period, that was a secular bear market.
Right.
That was right here, almost in the middle of the secular bear market. All right. Where if you compare it to today, we're in a secular bull market.
Okay.
And I'll show this again on some charts here in a second. Now, as we go into December, here's what December looks like. You are here. All right. So the next week, kind of quiet with news. And then the week after that, the week after next is going to be really busy.
Yeah. CPI, do you think so? What was CPI headline? What was it? 7.6?
7.7.
7.7. Oh, in the middle. You
7,
think we
7.
go lower?
Yes.
Yeah, I do too. Headline. Yeah. Okay.
I think we go lower, and the very next day is the Fed meeting.
And I'm guessing 50.
Probably 50. I mean, he's basically telegraphed 50 already.
Yeah.
I
good
think
news is I've been calling 50 for months, so I'm seeing no reason to change my opinion.
Yeah, I think he'll stick with 50, and then it will, be what does he say, and what's the next one, and is that where he's going to hold it for a while?
Yeah, I certainly think we get. I think it'll be 75, 50, 25 because I think he wants to show the slope. He won't go 50 to 0, in my opinion.
No, I agree. It'll probably be 25.
Yeah. Okay.
The next one. But he might stop after that, though.
He might. Yeah,
maybe one more 25 and then stop.
Yeah, I think we've got 100 basis points. 50, 25, 25. That's my guess.
Really depends on where we're at. Depends on the recession, or the recession talks really ramping up.
That'll be March, right? The next first meeting in 23 is in February.
Yeah, right.
Okay. Yeah. All right.
So he could hold there if recession starts really picking up, but the jobs number was pretty strong.
Yeah, 262 or whatever it was. Yeah, over expectation was
263 with 200 was the expectation. So this is again from Tom Bowley. It's really from Stock Traders Almanac, which does historical trends. So this is what December looks like. So the first half of December, it's positive 2.8%. The ones in parentheses are the number of days that it goes up. So more than half of the days the market's up.
Okay.
But the last half of December is where everything really picks up.
The Santa Claus rally.
And you can actually see it right here.
Yeah.
After this big busy week right here, where the market, I expect the market to go down going into this inflation report because they just don't know what it's going to say. And then if it comes in lower, I think the market's going to spike.
Okay.
But you see the second half of December right here, it just takes off. Yeah. And this is backed up by the historical trends. So December 1st through 6th, 46 out of 26 days are up. 7 through 15, 33 versus 39 are up.
Oh, so got it. I see.
Fewer up days than down days.
So that's again 33 up, 39 down. That's what that says. Okay, got it. Okay.
And then 57 versus 15 between 16.
Santa.
That's the Santa rally. Exactly.
I like it. Go Santa.
So, go Santa. Everybody thinks the Santa rally is going to be before, a couple of weeks before Christmas, but it happens Christmas week is when it usually happens.
Okay.
So again, this is from 2009. This is our secular bull market that we are currently in. And this is the cyclical bear market that we're currently in.
Yep.
We went right down to the 50% Fibonacci level. Katie Stockton thinks we're going to the 38%, which is at 3193 or 3200 basically.
Yep.
So she thinks we're going here, but we're right at the top of this channel. And this is why I said things are different this time. All right. The other thing, if you'll notice down below, this is the put call index, put call ratio.
Yep.
Notice every time it hits the peaks, the ones that are circlers is when the market came back down to the 200-week moving average, this gray dotted line right here.
Okay.
All right. Every time the put call ratio hits the peak of something above 0.8, and we hit that 200-week moving average, the market bounces. And look what just happened in October. We hit the 200-day.
Yep.
Put call went above 0.8, and now we're rallying. Exactly what it's done every single other time during this secular bull market.
Okay.
So we need to get through that next level.
Okay.
We need to get through where we are right now. There's where we are. There's the down channel. Every time we've hit that, 1, 2, 3 times this year, we got rejected. This circle here is the 200-day, and we're at both of those again, the down channel and the 200-day. We are right there. So next week is going to be important. Now, remember, we said next week and the week after, or at least the first half of the week after, the market could trend down. Historically, that's what it's done. It's trended down. So we could start down again. I mean, every other trader in the world is looking at this chart.
Right.
Everybody sees this chart, not just me.
Right.
Every single person. And every time we've hit it before, we had a big sell-off. The reason it's different this time is on Friday when we had that great jobs number, we sold off in the morning.
Yeah,
we came back.
Yeah, I saw that. 10-year too.
And the 10-year, yeah, I'll show you that here in a second. We should have just kept selling off. Here's the VIX.
The VIX came sub 20. What the
Look
heck?
at that. Yeah, the VIX is now, if you'll notice back here, when it gets below this 20 line, this dotted, this dashed red line here, when it's got below that previously, that's been the peak. That's been the high. Yeah. This one right here, that was the high in August. This was the high in April.
Yep.
And we are just about there again.
Yep.
So again, I would not at all be surprised to see some profit taking next week. See the market start to trend down in preparation for the CPI report.
Right.
I mean, this is kind of telling you that as well. And there's the 10-year treasury. Look at that.
Wow.
10-year treasury is right at 3.5.
Yeah, 3.49. It's crazy. It's
look at that red line right there. That's the support line. It was resistance back here in June, and then it became support here in October. And I wouldn't be surprised to see this bounce, because that's usually what happens when something hits support. So I wouldn't be surprised to see this start to go back up. It's almost right at the bottom of the channel line too.
Wow.
And I wouldn't be surprised to see the market come back down.
Okay.
Just because that's what it's done before, and everybody in the world is looking at the same thing. So don't be surprised if we get a little correction next week before the CPI number comes out.
Very cool. This
again is the secular bull. This is how I will know if we are no longer in a secular bull, if we started a secular bear market, is if these things turn red like they did back here during the secular bear.
Okay.
And they haven't yet. We came right down to it here and bounced up. We have not even close to zero on this one. We hit the 200-week moving average right here and bounced back up.
Okay.
So we are right at a critical juncture right now. There's the long-term weekly, kind of shows you the same thing. It's just starting to come out of that down channel line. I think that's it. So next week's really important. I think the market is poised to go higher, but I think in the short term, it's going to probably take a breather and decline or go sideways in the next week and a half before the CPI number. And then the CPI number, which I'm expecting to be lower. And I think the Fed will do what everyone is expecting them to do, which is 50 basis points.
Mm-hmm.
When those two things happen in a week and a half, I think, and we're at the end of the seasonal, seasonal period, the end of the year.
Yeah.
I think the market is just going to explode higher.
Yeah, it could be a nice Santa Claus. I think everything you've said makes total sense. I think CPI comes in light. Certainly headline, core, we'll see. Then yeah, I think we get 50. And I think the Fed talks about, we will do the right thing and basically indicate that 25 might be the next one. Yeah, I think all those things. And then you add the Santa Claus rally. It could be a fun, interesting end of the year.
And I think what the Fed is going to start talking about now is keeping it high for a long period.
Yeah. There's no cuts coming in 2023.
Right. I think that's going to be the narrative from now on. I mean, the narrative previously for the second half of this year is more pain ahead. We're going higher. We're raising rates. We're going to fight inflation with everything we've got. That's been the narrative. I think the narrative starting December is going to be, we are nearly there. Now we want to see what the effect of all these are, and we want to see it work its way through the economy.
Yeah.
And we're going to stay here for a very long time.
Yeah, we're going to stay here for a long time. I agree. I hear a lot of people talking about a Q1 pivot, meaning Q1 cut. I do not think so. I don't see it.
The only way that's going to happen is if we have a huge recession. And I've been saying all along from the very beginning that because we are in a secular bull market, the recessions are typically short and shallow.
Yeah.
In secular bull markets. I think we will have a recession next year.
Yep. Agreed.
But I think it will be short and shallow.
Yep.
And we didn't even talk about the GDP. What about the GDP number?
Yeah, 2.9 upward revision to 2.9. Yeah.
I mean, it's a strong economy. There's a very good chance of a soft landing.
I don't know. Very good chance. There's a chance.
So how do you define a soft landing? No recession?
Yeah, well, a soft landing would be no negative quarters.
Well, we've already had 2 negative quarters.
Right. I meant no negative quarters in 2023.
Yeah, I think that's possible. We still can have a recession, even without negative quarters.
Yeah, that's true. We could.
We could have a period of low or slow growth.
Yeah, I mean, if I were to call it right now, I think Q1, Q2 will be negative growth. I think housing pulls us into a recession. People don't realize with housing transactions going sub 4 million, with builders basically going to be building 50% of what they built a year ago, that's a lot of jobs and a lot of, the M2 money supply is crashing.
Yeah.
So I think we had to.
How about the dollar? Q1, Q2. How about the dollar? I put this in my newsletter too.
Yeah, rolled over. Yeah, rolled over. You actually called that 2 weeks ago, and you said gold would go higher. Yeah,
right. I mean, gold right there. Gold is starting up. There's the dollar.
You called
it. Inverse relationships. The dollar. I said if the dollar goes below this 21-day line, and especially if it goes through the 50-day line, then gold is going higher.
Yeah,
look at that rate. Look at the rate of change for gold.
Woo. Wow.
Crashing down. And then here's the 10-year treasury, which is also coming down, and the S&P right next to it. So all of these things are good for equities. I mean, they all are exactly the kinds of things that you see in a secular bull market correction.
Very, very cool. Dan, well, one more time, show your newsletter, because video number 2, we're going to talk about beginning technical analysis.
Yes. I'm going to, tell folks about if they're just starting out with technical analysis, what kind of indicators they should put on their chart and how they should create it, and what to look for, not to get overcomplicated with it. So it's Breakpoint Trading. If anybody would like to subscribe, breakpointtrading@gmail.com, and just send me an email and I'll add you to the list for next week. I'll send you last week's newsletter and I'll add you to it for next week.
Do yourself a favor, get the newsletter. If you don't like it in a couple of weeks, ask to get off. It's a very simple process. Something I look at nearly every week. So thank you so much for doing it.
You bet. Take care.